I realized that my family was going to grow up without me. And that was what really set these wheels in motion.
Welcome back, investor, to another episode of Passive Income Adventures. If you're new here, my name is Emma Powell, and I am retired early on passive income. And the whole goal of this show is to teach you how to be more intentional with your lifestyle choices so you can have more passive income adventures. And we'll basically teach you how to pay for it with both time and money. And our guest today is Ken Gee, who's been doing this a really long time and a passive income and commercial real estate expert coming in from Cleveland. Ken, thanks so much for joining us on the show today.
Thanks so much for having me. Thrilled to be
So
here.
you have a wealth of experience. And the thing I thought was interesting when we were first talking was that you and I are both multifamily people, right? But we're hearing a lot of multifamilies in a bubble. There's been a lot of pain, a lot of fear, and you have some really practical answers to that. So before we get into that, though, let's back up and have you tell us a little bit about your background, how you got into this, how long you've been doing it, why you think it's still the greatest thing since sliced bread, and basically catch us up to the present day
Yeah.
but really like where you came from and what your background experience is.
Yeah. So I grew up in Toledo, Ohio. Nobody's ever heard of Toledo unless they watch MASH. And Max Klinger was all about the Tony Paco hot dog thing. So that put Toledo on the map. So I grew up in Toledo, got my undergrad from the University of Toledo, moved to Cleveland, where I got my master's degree from a small private school called Case Western Reserve University. And so while I was doing that, though, I was a commercial lender at a bank that's now part of PNC. So I spent 5 years as a commercial lender, which now has proven to be a valuable experience. And then after that, after I got my master's degree, I decided I was tired of hearing my customers at the bank say, I don't know, Ken, let me talk to my accountant.
Mm.
I'm here, hello. But they wanted to talk to their CPA. And that was in part what led me to be a CPA. So that's what my master's degree was designed to do. So I became a CPA, worked for Deloitte for 7 years on the tax side. And as much fun things that you can do as a CPA on the tax side, I did get to do them. I did a lot of merger and acquisition work, a lot of due diligence, a lot of structure planning. It was really cool stuff, right? I did a little compliance at first because everybody does when they start out, but I really was to be able to do some of the fun stuff. But it's that experience actually is what changed my life, because at that time, my family was extremely young. My daughter had just been born. And so I think about accountants, 70, 80 hours a week. I would do my daughter's middle of the night feeding. And so 3 a.m., imagine the house is silent. My son's asleep. My wife's asleep. And it's just me and my daughter doing her middle of the night feeding so mom could get some sleep. And I thought, man, this is cool. And then I realized, wait a minute, this isn't cool, because this is the best I could do for my daughter, is to spend time with her at 3 in the morning. And that got me thinking. The more I thought about it, the more I got frustrated. And I thought, wait a minute, this isn't cool, because back then everybody go to school, get good grades, get a corporate job, you're golden for life. But then I realized that my family was going to grow up without me. And that was what really set these wheels in motion, right? I think at the time I had one small property. It was supposed to be my retirement, right? But now I realize, wait a minute, no, I need to move. I need to move on this. So it's been about a year and a half trying to figure it out. Now we're talking in the mid 90s here, mid to late 90s.
Yeah.
And there was no podcast like this to help you figure this stuff out. So I
You had
got to
Carlton
go.
Streets at late night TV. Come
Yeah,
on.
well, there was Carlton Sheets. That's exactly right. So I watched Carlton Sheets infomercial about 800 times, did buy his course. He only did single family homes. But
Yeah.
so what I did was I went to local apartment association meetings, learned as much as I could, developed relationships with the people that taught at those meetings, that lectured or whatever. And that was how I figured out multifamily. So what happened was, I had, over a 3-year period, I bought 3 small properties, a 28, a 24, and a 22 unit property in Cleveland, a place called Shaker Square in Cleveland, Ohio,
Mhm.
and sold them in 3 years and made $500,000. And I thought, well, whoa, wait a minute. Are you kidding me? This was ridiculous, because I just made more money on the side than had up until that point at Deloitte. And I thought, wait a minute, I thought real estate was going to get me where I wanted to go, is going to give me a business where I could have control over my time. And I wasn't wrong. So now fast forward 26, 27 years. And I will tell you that my family didn't grow up without me. I got to go to almost every single one of my daughter's AAU games, as she traveled all over the eastern half of the country doing all the AAU stuff. My son, he pitched, played baseball, got to see all those games, got to see all their events. So it did give me the quality of the life that I wanted. That was for sure. And it's actually given me far more wealth than I think I would have ever dreamed. So that's where I got to now. Now, fast forward, we're 19 deals in. We've raised about $45 million. Our senior management team's managed over 16,000 units. That's my story. And that's why I'm certain I'll never do anything other than multifamily for the rest of my life.
Yes.
I'm sure.
So let's say you've been around the block a couple of times
So,
because, like you said, and here's the thing that gets me wondering. You said Carlton Sheets, for example, only
yeah,
did single family, and that's how most people were investing back in the day. And I've heard people who were investing in 80s and 90s talk about how competitive it was because they were all living in the same town, going after the same old lady's smelly cat house, and they were a little bit combative. And the whole houses were still cheap enough that then they didn't need a lot of private money to be coming into the deal. And so they weren't trying to schmooze each other as potential investors. And it
right.
was much more competitive. But then when the Jobs Act came out and basically changed securities rules that we could advertise syndications, that took, first of all, time to actually set in and to become
Yep.
effective.
Yep.
But then it took a certain number of years for people to start hearing about it and trickling through to the masses, right? And so most syndicators or people who are experienced in multifamily are really only 5 to 6 years into this process, but you figured it out a lot sooner. So the structure was probably different when you first started, maybe more of a joint venture. Okay, so first of all, what even put the idea of commercial real estate into your head at that point when most people were still battling it out for single family houses? And how have you seen the industry change as 506C advertised syndications have become more of a normal thing in the industry?
Yeah, those are good questions. So why did I get to multifamily over single family? So what happened? I want you to rewind my story back to that beginning. And remember, I was working at Deloitte. I was a CPA, and I knew I wanted to be in real estate. So I looked at all those different classes of assets, right? I looked at 1 to 4s, and I thought, wait a minute, I don't have enough money there to go pay a plumber, to pay a leasing person, because I was already working 80 hours a week at Deloitte. The last
Mhm.
thing I needed was more things to do. Plus, I don't know how to fix anything. That would have been a train wreck for me. And then the final thing I was worried about with single families, I thought, man, we eke out 50 to $100 a month. Maybe people do better now. This is just how I viewed it at the time. And then all of a sudden the roof goes or something
Mhm.
major. There goes all my profit. I just couldn't see. I was scared that I couldn't really make money on it. Then I looked at multifamily and I thought, wait a minute, I like multifamily because, ready for this, I could run that first 28 unit as a business. And as it turned out, it was actually easier for me to do because I found a lady who didn't drive. Shaker Square is a very small community. Everything she needed was right there. She lived at the property. She liked kind of being in charge, being the little property mayor. And she showed the apartments for me. She took care of really light maintenance, like changing light bulbs and things like that.
Mhm.
So suddenly now I had that person that I could delegate things to. So I could run it like a business. And that's what got me into multifamily because now that seemed to make sense. What I didn't fully understand at the time was this concept of how you grow income, grow NOI, and that translates into value. I quickly learned that, right? Remember this, I went in pretty green, probably a lot greener than I should have, but it was all my money. So it was okay. I was that and my in-laws. So if I lost my own money, I wouldn't like it, but I wouldn't feel bad that I lost somebody's money that I didn't even know. So what I did through that process, that first deal, is I learned the concept of adding value. I learned that if you go and make properties nicer, you'll invest 5 grand into an apartment, but then you'll be able to rent maybe for $200 more. And that's how value is created in multifamily. And once I figured that out, I thought, wait a minute, this now so many bells, whistles, lights, whatever you want to call it, went off in my head. I mean, now I really like this business because now it stood to reason that if I could find a property and make it generate more cash flow, there was a pretty good chance that someone would be willing to pay me more for that. And that's the basic concept of multifamily and value add investing. So that's how we got into that 28 unit building. That's why I made the decision. And that's why, as I continue to understand how money's made in the multifamily space, that's why I never got out of it and probably never will.
Yeah, it's surprising to me because the way I learned it, there were podcasts everywhere, there are YouTube channels everywhere. We had people coming to our RIAs raising money for 506C syndications right in the real estate meeting.
Mhm.
And I knew before that, the commercial was where it was at because I often tell the story. My husband grew up in a small college town,
Mhm.
and a lot of his rich farmer neighbors owned these little apartment buildings in town. And so it wasn't that odd that a wealthy person could own an apartment building by
Right.
himself. And I only thought large stuff was corporations and things like that. So I didn't really understand a lot of the structure, but I knew at the beginning, like commercial was where it was at. But I quickly found out that syndication commercial was kind of this new thing in
Mhm.
2018. People were really starting to talk about it. And I had these trailblazers before me. And oftentimes, when I do something that I feel like is a little bit risky, I'll go find a group of people who are already doing it. And then I don't feel like a trailblazer. I just iterate on what they're doing or just copy what they're doing. But
Mhm.
in your case, you probably didn't have that. You probably didn't have mentors to teach you how to run numbers on those things. And
Yeah.
all of the resources that we have now, I can just go to a website, type in free commercial calculating underwriting tool,
Right.
and there are people who have them sitting there waiting. So
Right.
tell me about that learning curve for you when you didn't know anybody else already doing it.
Yeah. The first 10 years that I was in the business, I didn't take anybody else's money. It was
Mm,
me. My first deal was my in-laws. That's family money. And it so I did have a partner early on. He's now retired. He was super kind because back then I didn't have a balance sheet. I didn't have any liquidity or money. And so I needed to solve that problem. He and I got together. He's one of those people that I met at the apartment association meeting, developed a great relationship with him. We built a trust, a good trusting relationship. And he was kind enough. I just want to tell you the story of how it happened here. So he was kind enough
mhm,
to he would invest most of the money. I still had to have some of my own, but not as much, and we would split it even 50-50. I did the
mhm,
work, he lent me his balance sheet liquidity and, most of the money, so it worked out. That's how I got started, but here's what's really important and what made me feel good about what I did, is I spent 10 years in Cleveland managing my own properties, buying my own properties, selling my own properties, making money. I'd done multiple full cycle deals and proved to myself and then at some point others that I actually could do this thing and make money. So what happened was I thought capital is the restriction here. So I think
yep,
it was '04. I could be wrong, but our whole entire track record's on our website. So the property was Van Aken Crossing. That's the property that we first indicated. But I drew on my experience when I was at Deloitte, because one of the things that you do that I did at Deloitte in the M&A side was work with private equity firms. So I
mhm.
had tons of private equity
Oh,
firms and clients, so I understood what they did. It just I thought, "This we need to do this with real estate." At the time, the Jobs Act had the Jobs Act been I don't remember if the Jobs Act
I
had
think it
been.
was 2012
Yeah,
when that
yeah,
was it didn't take effect right away.
yeah, so what I did, I'm not sure, I don't yeah, I might have my dates confused here. No, it was back in the early yeah, it was pre-2008. So we went
Mhm,
out to a few select people that we knew. We knew these people really well, said, "Hey, give us some money, we'll do the thing." And that's what we did with our very first syndication. So what happens with me is I don't like experimenting and learning with other people's money. I get worried about that. I watch people
mhm,
do it with the big professional firms. So I was always really paranoid of that. And
mhm,
so once we got into the syndication, now we realize, wait a minute, we now can do bigger deals, apply the exact same business model that we had used for 10 plus years. And now we just started doing it more. And what happened after multiple syndications, after the first syndication, I said, you know what? We're doing well. We're in Cleveland. But here's the thing. What if I actually did this in a market where people really wanted to live? And I like Florida. So 15 years ago, I said, you know what? I got to go figure out Florida. So I started coming down to Florida and just learning and touring and meeting people and just developing that whole network. It was that trip to Florida, those trips to Florida, that uh, developing my business in the state of Florida that really allowed us to grow in terms of syndications. Because when you tell an investor, hey, do you want to invest in Cleveland? Their hands don't shoot up right away.
yeah,
They just don't. It's not exciting. But if you say, "Hey, I've got deals in Florida," you get people's attention. I noticed that very early on. So we had turned several syndications in Florida, been very successful. But then I had a new problem. The new problem was everybody else is syndicating in Florida. So every
yeah,
deal was 20, 30 offers and, "Hi, Mr. Broker, I promise you I'll raise the money." That's what everybody else was telling him. So the only way to differentiate was the price. And I thought, you know what? Imagine, remember, I had this private equity background. Private equity raises the money first and then goes and finds the deal. I said, I need to do this in multifamily because now I'm the guy that's already raised the money. Mr. Broker, you don't have to worry about me raising the money because I already did. And so we started a number of years ago and flipped from the syndication model to the fund model. That's why we did it, because we wanted to differentiate and get these deals that were really killer deals. And so we did that. We did that. The first fund that we did, the first deal never even saw the market. The next two, we weren't even the highest bidder. So now I've proven the fund model works. So now, only because we were able to do it, only because we had this long track record that we could show people we've done this over and over. We're just doing the same thing. We're doing it, and you give us your money. We promise to make good decisions and do our best to make good decisions and buy assets similar to what you've seen us do in the past. And that's how we've made that foray into funds. So that's the process that we went through and why we went through it. I will just tell you, though, the moment you jump into using other people's money, it gets scary because you lose your own money. All right, that sucks, but at least it's still your own money. When you lose money, somebody else's money, it's not just the legal liability that you're worried about. It's just the internal. I would feel horrible if I lost somebody's money. We've
Mhm.
never done that.
Yeah. Oh, okay. So I'll just so
There's a lot there. Sorry.
in that. So I'm trying to think like what's the most important thing because my issue sometimes when I'm on the podcast interviewing is that when especially when I'm talking to somebody who's in the same industry as me, is I want to go get out into the weeds and aiming it at like somebody who wants to do what you did and go start their own business. But most of the people listening to the show working 80 hours a week and they don't actually want to go start a real estate
That's right.
business, but they want to learn about it so they can make smart decisions when they're investing passively in other people's deals. And so I think the thing that I could ask a lot of technical questions about what you said, but I think what might be more useful is how you got to that point where you were doing the 80 hours a week at Deloitte, but you had that background and that knowledge because a lot of high achievers, especially those who work in finance, do have a background where it's tempting to say, I'm gonna go start a real estate thing on the side. And you mentioned several times a track record is what allowed you to raise institutional capital, but you had to get the track record on your own money because back then syndicating from retail investors was not a thing. And now we've got this retail versus institutional. Most people start raising retail capital so that they can get a track record so that then they can go after the
Yeah.
larger checks from institutional capital. You had to do it with your own money and then you went straight for institutional. And so I'd love to hear more about how you balance like private equity from institutions versus
Sure.
retail mom and pop type of
Yeah.
high achieving corporate executive type of people. And also that transition that you were like, I need to go start this as my own business because back when you did this, it's not like you could just go invest passively in someone else's thing. So to that person who today is listening to your story and they're trying to say, "Do I really want to do that?"
Yeah, yeah. So let's speak to the institutional thing. So we've actually never accepted a dime of institutional money. The people that got into our first deal were literally our friends. We
Hmm.
just all went in together. So that's the line might get blurry, but that's really not a syndication. Those are just a bunch of friends getting together to do a deal.
Joint venture.
Okay. Yeah. So and the reason we've never wanted institutional money is that I want, well, here's what happens in our business and probably any business. He or she who has the money makes the rules, right? So there's a lot of we get these requests all the time. The LPs want to write the 5, 10, 15, $20 million checks and be the equity for the deal. But the problem is then they're in charge, right? Now I'm working for
Mhm.
them. And I've never wanted to do that. I always wanted to do my own thing and not, because remember, I came from that corporate environment where every year under everybody's thumb all the time. And I just didn't
Mhm.
like that experience. So we've always raised money on the retail side. Early on, it was much slower than it is now. It just is. I just want to be clear on the institutional thing. Now, people trying to make this decision about how they do this, everybody, we were talking before the show about how this decision process, every single person, almost every person has to go through this, right? They know there's a ton of money to be made in real estate. They're just trying to figure out how it fits in their life. And I will tell you, I've had some of the craziest conversations with people who are incredibly successful, insanely smart, like almost rocket scientists, doctors, and they want to abandon that to jump to real estate. I'm like, time out. I want you to look at your life and be realistic about this because you don't get rich quick in real estate. Real estate is not a get rich quick thing. It is a get rich with more certainty thing, but it is
Yes.
definitely a long-term thing, right? We can't pull the risk out of it. So I want people to really look at their lives and look at what they're able to do. Now, so most people should be on the passive side. They should, because what happens to most people is they think they want to do what I did and they start down that road and then they realize, wait a minute, this
Yeah.
isn't an apartment building. This is a whole business. I got employees, I got insurance, I got maintenance, I got legal liabilities, every single thing that goes on in a business you have in an apartment complex. And they realize, man, I really got to know the little nuances, right? You got to know the little details. You got to have best practice. And they realize, man, this is a lot of work. So most people will start off with this intention to go down this active side and do their own deals. But then they realize, you know what? This probably isn't such a good fit. I'm really good at what I do. So maybe I need to stay on the passive side. So what they do then is they look at guys like us and our track record and realize, wow, if I could earn 15, 20, 25, whatever percent, there's no guarantees, but if I could make that kind of annual returns with doing nothing, that's what I should do. Why would I want to take on all this risk when I can get pretty darn good returns and let somebody else with experience do it for me? And that's how most people end up, but that doesn't mean that they start there. Most people start off, they want to do their own deals, then they want to get in. So they'll do both sides. And then over time, they figure out where do they think they're going to end up. And I will tell you, most people revert back. But here's what's important. When they do revert back, they're way smarter
Yeah.
because they spent time studying what we do and what other people do. And they're able to ask the right questions. They're able to tell if somebody on a webinar is just glossing over the answer, right? That's what I call
Mhm.
being PC here. But that happens a lot. So I do believe very strongly in investor education. I told you that's why we have an entire line of investor education products in our business. That is not where we started, but I've learned that this business is so incredibly lucrative if you make good decisions, then if you know what you're doing. And I wanted to I wanted to educate people so that they can make good decisions about who they invest with and make sure that their money is safe because you don't want to lose money in this business. There's no need to.
Yeah, it's such good stuff there. And I think that one of the reasons that this problem exists is the term passive income or even financial freedom, as it's been coined. People say, oh, passive income is a myth. There's no true passive income. You have to do due diligence. You have to meet the people. You have to network. You have to do all the things. And so, therefore, no income is passive. And I think that really doesn't accurately portray what we're talking about. The passive income is generated from investing in a business that someone else runs, period.
Yep.
You have to vet the business. You have to look at it. It's like saying that the stock market's not passive because you have to look at your portfolio and read the prospectus. And if
Right.
it's a company that's allowing like an annual meeting and a voting, you have to be educated enough to go in there and do that. The income itself derived for you is passive. You don't have anything to do with the business. You just have to pay attention.
Right.
And so that idea that, oh, since no income is actually passive, maybe then I can just go and start this business because no income is passive. Passive income doesn't come from a business that you run. It comes from a business that somebody else runs. And so what they're thinking is maybe I can have a hands-off business. And maybe I can do this and delegate a lot and have a property manager and all this. And so I think that the lack of understanding of what we mean when we say passive income sometimes lures people down the wrong path because they're hearing both messages. Oh, you get passive income and sit on a beach, or there's no such thing as passive income. And there's no technical term to define what we're talking about. Distributions and dividends? I don't know. So how do you find that terminology actually might confuse people
It does.
more than it helps people?
Yeah, it's even worse when you get to the 1 to 4 families. That
Mm,
really is muddy. That gets very confusing to people because they think that duplex is passive.
no.
It is it is anything but, because now you can't afford to pay a plumber to go over there every time something happens. You can't afford a lot of the stuff. So it becomes a job. You basically invested in a job for yourself. So
Yeah.
that's really bad in the 1 to 4s. But you're right. You're dead on right. This is a business. It needs to be run by people. And after you vet a sponsor, I don't want anybody going all in with one sponsor. Don't ever do that. That's just a bad idea. But what's going to happen is you're going to vet that sponsor, develop that relationship with them. And we have most of our investors come back because we keep performing over and over. And it truly is passive. It's a phone call. What are you doing? What's new? What's your plan? How did your plan change from the last fund? Okay, yep, I'm in because I have more capital. And that's basically how it goes. That's passive. And I think you're right. It does confuse people. But I think the people that say there's no such thing as passive income is really, you're really getting technical there. And I would dismiss that. I don't want to be disrespectful of their opinion because technically they're correct. There was some work involved in it. But
Hmm.
after you've vetted the sponsor and you're not making a decision about what rent should be, you're not making a decision about whether or not you should approve an app or not approve an application and all that. All that's delegated to somebody else.
Yeah, but then I think it's also muddied because the IRS calls rental income unearned. And so then I'm like, wait a second,
Sure.
if they call it passive income, unearned income derived from rents, that actually took me a while to figure out because I don't have a tax background. Income and my unearned income because I'm earning that rent because I run those buildings. I self-manage because I'm a real estate professional. And so there I had to have some buildings that I self-manage so I could hang on to that
Mm-hmm.
designation. And
Yep.
realizing, wait a second, why are they even calling this unearned income with rent? I could see that distributions and dividends is unearned, but then interest income is considered earned. When I didn't do anything to earn that interest income, I delegate people to service that loan. So for me, the IRS kind of muddies that whole idea of what's earned and what's unearned income because of the way that they define that. I don't know. Have you
Well,
seen that?
yeah, what you have to do when you think about, I'm not going to get deep in the tax code, but what you have to think about
Thank you.
on the corporate side, tax code is a lot easier to understand because it
Yeah.
makes sense, it follows logic. But on the personal income side, it doesn't follow logic. And what you have to understand is what is Congress trying to incent? And there's a lot to be said for people in Congress own real estate. So they're
Yeah.
talking their own book here, right? The government has always wanted to incent residential investment and investment in real estate. It just has. It's always been tax benefited. Now, pre 1986, those rules changed everything. And everybody
Mhm.
thought, oh, real estate, no one will ever buy real estate again. That was wrong, right? The benefits weren't as good. They were starting to buy real estate for the right reasons. Now, I have these
Mm.
discussions with investors all the time. Segregate the tax thing and the real life, the economics of the deal. And that's what I tell people to do. You got to analyze the deal based on a true economic. Is it generating positive cash flow? Yes or no? If it does, and you can see cash flow going up and it's going to be worth more, that's your decision to buy or not buy. Oh, by the way, there's this whole set of tax rules that flow to your tax return, even definition of capital and what's return on capital and what's return of capital. All those are tax driven things and you don't need to worry about it. What matters is what hits your tax return. And usually it's a loss until you sell. Just segregate those two things and think of them differently, but start with the economics because what I see so many people do is I call it the tax tail wags the dog. Don't let that happen
Mm.
to you because you've got to make economic sense of the deal. And then the tax benefits are what they are. And just realize that you're not going to be able to apply logic to what they do on the personal side because it's literally arbitrary.
Yeah, and that's a good way to put it because when multifamily was approaching its height, its bubble, I think the bubbles really burst. I don't know, we can get into that a little bit more later, but when it was bubbling up and the lack of the lower barriers to entry increased the competition. And so even though it was easy for us to get all this information than it was for you, it also meant there were a lot more people bidding on deals.
Oh, yeah.
And
Oh,
I
yeah.
saw dumb 1031 money and dumb opportunity zones making business decisions because people just wanted to get a deal because there was the FOMO that, oh, multifamily is a thing and I don't want to miss out. So that really taught me like the deal has to have fundamentals and I'm buying my deal for different reasons than a lot of people are buying because I don't have 1031 money that I'm just trying to preserve. And so I can buy a deal that's barely breaking even. Or I'm not buying it on fees like some institutional buyers would be. We're collecting commissions, we're collecting asset management fees, we're collecting refi disposition fees. So they're really functioning on a fee base. And so they could pay their whole financial model is different than mine. And so I was just like, I just got to get a deal that makes sense without any taxes, without any fees, without any of that. And if it makes sense, then it's gravy, whatever I can do on top of that. But I see a lot of investors not making decisions based on that and therefore having completely different economic models when they're evaluating a deal. And that's why they can pay more than I was.
Yeah, there's 2 things. To the 1031 model, I will tell you, brokers love, love 1031 buyers because they
They're in a
know
hurry.
they will be willing to pay. They know they're buying with a gun to their head, and
Yep.
they just know that the thought of paying that tax is just so egregious that they will do anything to avoid it. And you have given the person you're negotiating against all the power. And that's
Mm,
why I don't like, I've never actually done a 1031
me
in
neither.
the 27 years I've been doing this. Now, that's why, because I don't like to buy with a gun in my head. I just don't. So that's the first thing. The second thing is this FOMO thing has more to do today with what's happening today than because I want you to imagine somebody starts learning about real estate and they hear all their friends are doing deals and this person's doing a deal and that person's doing a deal and they haven't done a deal yet. And what happens is they start reaching and then they just don't understand that these things can go wrong, right? We're pretty slow to get deals. That's probably to our fault that we don't get deals as quick because I'm not, we have that discipline because we've been doing it so long. I've seen things go wrong, things go bad. I watched other people do it. I'm not going to do it. So that FOMO thing kicks in and it's really interesting watching people's behavior because they ignore almost common sense. Why do you, I told you this is what's going to happen. I don't know why you don't believe me, but you did it anyway. And that's, I can't stop you from doing it. But then once you're in that deal, you find out, oh, I'm not making money. Now you're toast. Your investors lose, you lose your credibility. And that is happening left and right now. Somebody called this. I talked to somebody yesterday. I can't remember who it was, but they used the term new ruse. Ever heard
Knew
that?
what? Say
New.
that again.
So think of guru, Guru, substitute N, new ruse. I my goodness, this is exactly what's happening because and you know what? They're very well-meaning new ruse. They're working hard. They're trying to figure it out. They think they're doing good deals, but what they lacked is experience right now managing debt. We've been around through 08, 09. I know what bad debt markets look like. I have been through that ugliness. We didn't lose any money, but I watched a whole lot of people fail. But it shapes the way you manage debt. Well, wait a minute, I'm going into real estate. What do you mean? And now I got to know about debt. That's what is hurting people right now is they didn't have a business plan that really could get implemented. And so now they can't handle the increased interest expense. Number two, they didn't ever dream that rates would did.
No,
So they didn't protect themselves, or they did, but they didn't protect themselves long enough.
enough.
Going to get in and out in 3 years. So it's inexperience. I don't want to call them rookie mistakes, but they're debt management mistakes right now.
Mhm.
That the other part of it is they just had ambitious business plans that when you go back and really forensically study what they did when they did their due diligence, they really didn't visit rent comps. I see this all the time. They really let the broker convince them that rent could be here and they didn't prove it themselves and all those kind of mistakes. So those are what's happening right now. It's creating a massive opportunity to buy right now because there's a lot of those folks out there who they have to sell. They don't have a choice. Either that or the building goes back to the bank.
Yeah. And I'm
Mhm.
thinking about a property in particular that we invested in that went bad. It's the one deal that we've lost money on in all of this pain. I was talking to somebody recently who they're having a lot of foreclosures. Like half the portfolio is foreclosing. And I said, what is going on there? I can see maybe the one that you bought at the height that the rate cap became $350 a month to $30,000 a month, right? But it's like, who even needs a rate cap if that's how expensive it is? I've seen some of those go bad because they bought at the height and it was right when rates went up. And so I'm seeing that they were spending their construction money to pay the mortgage. And the whole thing spins out of control because if you don't even have enough money to do turnovers, the property manager's not getting paid. Then the thing starts to deteriorate. It starts looking ugly on itself. So I've seen a few of those go
Yes.
down, but they were bought in a very narrow window of time where interest rates looked great, looked fine, right? January 2022, December 21, like kind of that
Yeah.
time frame
Yeah.
before people were whispering about this. And then COVID stimulus payments went away. About the same time interest rates started to skyrocket. And so you had a lot of people who were paying their rent because they had this extra money. And then you had a lot of people who suddenly couldn't pay their rent,
That's right.
coupled with the payment getting a lot higher, even with a rate cap getting a lot higher, and those rate caps getting more and more expensive. So I've seen a few go bad for that reason that are like, you just got caught in that perfect storm there. But to have so many half or more going, did you buy them all during that 4 to 6 months? Maybe, I don't know. So
Yeah, they
I've
probably
I've
did.
seen that happen.
Yeah, but remember, rate caps go out for 3 years. So
Mhm,
you could still buy a rate cap BD. We were buying all through that time. We're just,
mhm,
so we did a bridge loan on one deal And 10 months in, I just didn't like what I saw. I put
Mm,
7-year debt on it, right? Now see, this is the key. You've got to have a good business plan. Like, we won't look at deals unless we think there's 2 to 300 in upside, and not the hope and pray that over 10 years it gets that. We're looking at the market today, and it appears as though that upside is there now. And the reason that's mattered to me, especially when you're doing a value add deal, is I need to go in and add value as quick as I can, especially when you're on a bridge loan. You don't want to get behind on that. So 10 months
mhm,
in, we had added enough value that I could take out that bridge loan and then some with long-term Fannie IO debt at 65%. And so now we're good. We're good for 7 years.
mhm.
Remember, I'm going back to debt management here. That's what's going on right now. So there's two things. One, your business plan, you have to execute as fast as you can. And when you're using third-party management, it is harder to do that because remember, our deals, we're managing our own stuff. We're fully integrated, vertically integrated. We manage our own stuff. So we get the reward of everything that we do, or we pay the price if we don't.
Yeah.
And third-party managed situation, there's not that level of urgency. Remember, they're just people that come to work every day. They don't have the upside. It's just a job for them. They're just fee-based. There's no real true incentives. So when I see people struggle, it's the business plan that didn't get implemented on top of the fact that their interest expense got out of control and they didn't control their interest rate risk through the process.
Mhm.
So I would always rather be in a 7-year debt, a 7-year deal or a 10-year deal and have to rely on somebody doing a supplemental to be able to sell or even having some prepay. It is much better conversation that I could have with an investor says, look, we're going to be in this deal longer than you'd hoped, as opposed to I aggressively manage debt. I'm sorry, but the debt got away from me and we're going to lose the building, right? I always want to manage that downside risk. And that's what I would encourage everybody to do. Give yourself that leeway. And so what if you're in the deal longer than you hoped? It is better than the alternative.
Yeah, and what advice can you give to the lay investor about what they should be looking for when they're evaluating the conservative use of debt? Because one of the great things about real estate is that it's leveraged because I can't really
Yeah.
borrow money to go, maybe an unsecured loan to go buy stocks, but I can borrow money that's secured against my real estate. And it makes it unique and helps to boost the returns on that, regardless of the tax benefits. But a lot of times that tool that's very handy can also be very sharp. So, how can a
Well,
person evaluate if that debt's being managed well by somebody that they're trying to build up a relationship of trust with?
yeah, you have to stay low leverage. I think we're at 65%. That's what we like. Our current
Mhm.
fund that we're raising money for right now, we expect to go into every deal below 50% leverage. Why are we doing that? Number one, because I think this is a tremendous time to buy. Why is it a
Mhm.
tremendous time to buy? Because in debt is so hard to get right now. If you're a
Yeah.
newbie, haven't done this before, you're trying to raise 70, 75% debt and get the rest of it, you're not going to get the deal. The deal's not going to happen for you. So now the only people that can get the debt are the strong buyers. So when debt is a problem, this happened back in 08, 09. If you bought it in 2011, you're rich right now. Or you
Yeah.
were. You couldn't make enough money. So I believe it's probably not as bad as 11, at least not at this time, but
Mhm.
it's a similar opportunity. So I want to go in at very low debt because what lender, okay, Mr. Lender, I want to borrow 40%. Okay. They're not even going to argue with you. You're not going to
Mhm.
have to really that's not going to affect you, right? Your ability to close. So if you can get 50% under debt, that's what we're doing right now, because I think the basis is so important that we can get in at right now. That's why we're buying right now. And so when debt's the problem, you just take that out of the equation. Or if you can, just pay cash for the property and then put
Yeah,
debt on after it recovers.
so that cash pay or that low leverage pay oftentimes hurts the cash on cash return. You have so much more cash in the deal. What are you
Only if
seeing
you
in
buy at a low cap rate. I didn't mean to interrupt, but only if you buy at a
Oh,
low cap rate. If you buy at a 5.5, 6% cap rate, most investors won't. Okay, I get 5.5%. I'm cool with that. The most investors that we have dealt with, they're okay
mhm,
with. So you
mhm.
shouldn't be buying anything at a 4 cap right now, no matter what. I don't
Yeah.
care whether you have debt or not. Don't buy at a 4 cap. That's silly. You're
So
massively overpaying.
are you seeing though at the higher cap rates that lower cash flow is being washed out of the equation and people more willing to accept having more cash in that deal? Because that's one thing I've been seeing is that as more cash needs to come into the deal to basically get the leverage down and also more reserves, things like that, the cash on cash returns are dropping even more. Like when I first started, people were saying 10%, then I'm starting to see 6 and 7%. So how have you seen that trend?
Yeah. So we don't buy a market. Florida, I don't even, maybe back in 8 or 9, it was a 10% cash flow play, but I've not seen Florida at that on a kind of
Mhm.
cash flow. And so what happens in the maturity of a firm like ours is in the beginning, you do the really tough deals in the tough neighborhoods and the really big value adds, and it's a battle, right?
Yep.
And as you continue to mature, you realize, man, that's a tough way to make a living.
Yeah.
So your asset quality just generally improved. And when you do that, your cash flow generally goes down. Now, our target cash on cash in our fund four is 6%. So here's where people get confused about real estate. There's two people in a deal, the debt person and the equity person. And so the cash flow, if you buy at a 6 cap, as long as your investor wants 6 and your lender wants 6, you're good. Everybody's getting what they want. Even at low leverage, doesn't matter if it's low leverage or high leverage, they're still getting 6% on their capital because the entire deal has to be funded. It's either debt or it's equity. Now, if you're buying at a 4 cap, that's a different story because now there's not enough money in the deal to make both parties happy. So you got to maintain a 6 cap. You shouldn't be buying it's called negative leverage. You don't want to be buying at a 4 cap when interest rates are 6.25 on the smaller deals. It even gets higher than that. You just don't want to buy that because that's not going to make your investors happy. So now here's the key though. So now let's say you're in a deal and you're at 40% leverage, right? That's pretty low. We would all agree. But I didn't go at 40% leverage because I want to buy at a low cap rate. I did it because I want to take that out of the equation. I'm still going to hold the line on my cap rate at 6. If I can get a newer asset near 6%, we just closed on a property in St. Pete, 102 units, right? Newly leased up, beautiful property, and we bought it just under a 6 cap. Why? Because that's where the market is right now. That's where you should be buying right now. And so fast forward, we add some value because we're going to raise rent some, right? They were below market when we bought it. And we're going to we will likely get some interest rate reduction. Not promised, but we might get some insurance relief in Florida. And in 2, 3, 4 years, we'll be able to refinance those investors and get them maybe out all the
Hmm.
way and their capital out and they're still in the deal. So you got to take what the defense is giving you here. And when I say to you, debt is the problem, don't rely on debt to close. That doesn't mean you have zero debt, but you'd have low debt. So it doesn't impact your ability to close. Close the deal and just ask your investor to be patient because most people right now, I talk to investors every day and almost every single one of them I talk about is in a deal that is not doing well. And they
Hmm.
recognize now the experience that we bring to the table and they recognize low leverage. I like that a lot better than worrying about losing my money. So we're not
Yes.
having trouble raising money, believe it or not. And maybe it's because we're 27 years into the business.
Yeah, and I am seeing that because we're having capital flight and liquidity is reducing as even just demographically, you just have less
Mhm.
people my age. 45 to 55 is really like the
Yeah.
foundation of most private equity on these types of things. And there are just less of us. Gen X is just not as many.
Right.
Boomers retiring, things, capital flight for things like that. But then also an election year, people are in a lot of deals right now that are not performing. And people
Mhm.
are finding it's incredibly difficult to raise capital right now, especially they're looking at deals, they're like, "Oh, like I was getting 10% or 8% preferred return and then this much." So they're having to take lower. And I'm seeing just the wind has come out of the sales on investors. But the ones who keep investing with us are the ones who are like dollar cost average kind of mindset. And they like a lot of private debt. They like a lot of just more reliable cash
Yeah.
flow, safer, and
Right.
they're still making moves instead of people who bet big and are getting spanked and then they get out. They're going to be the bigger losers in the long run because they haven't stayed in the game. They let that loss spank them. So, what's your thought on that about the difficulty of raising capital right now with the way everybody's feeling versus the people who just get it and they understand like you just got to stay in the game and stop swinging so hard for the fences? I don't know. What are you seeing there?
Yeah. What I think is first of all, capital is never easy to raise, but for good deals that people like and they
Mhm.
make sense, the money will find those deals. That's what I believe. And I know that because I've experienced that. If I pitch a crappy deal, it's not going to get it. Nobody's going to invest. They just won't. Ken, you can yell from the rooftops if you like, but this deal doesn't look very good to me. It's ugly. I don't like it. It's in a terrible part of town. Whatever the problem is, they won't invest in that. But if you got a great quality asset in a great area that people believe in, the money will find you. And so the biggest thing that's happening now is this new RU experience bifurcation. This thing that's happening right now actually helps firms like ours a lot, because everybody thought that everybody could make money in real estate. And now they realize, whoa, wait a minute, there's a little more to this, right? And they're not wrong. And I don't want anybody to lose money. That's why I said we created this entire investor education side of our business, because I don't want anybody losing money, because it actually hurts me too, because that's
Hmm.
fewer people that want to go into real estate. You lose money in real estate, you're probably not coming back. But here's the thing about where you are in the cycle right now. Warren Buffett is probably a smart guy. He has always bought. He always runs into the fire. If you think about a lot of the way he's invested, he's looking for undervalued things. And when the building's on fire, that's when you got to run in and buy. And you look at the stock market, same thing. I suck at the stock market. I don't do stock market anymore, because I am that guy that would buy on momentum, get in at the top, and it would crash. Then I'd be like, oh my gosh. Then I'd get out. That's the absolute worst thing you can do. The worst. It is the exact opposite of what you should do. And right now is that time in real estate. That's why I said I'm all in right now, personally, because I couldn't invest back in 11 for personal reasons. I can now. You better believe I am not missing this cycle. No chance. And it's because all of these things are stacking up in our favor. I don't know how long it's going to take to normalize, but it will. We just don't know how long. At least that's my opinion. Remember, this is one man's opinion. So that's why
Have
we're all in. And if we could, all you got to do during these tough times is not lose your building. So stay low leverage. If you paid cash, how can they take your building away? They can't. You have no leverage. You really have to screw it up to lose that.
Yeah, that'd be like way underinsured or some problem too.
Yeah, there you
Yeah.
go.
Yeah, like you bought in Houston with no hurricane insurance or something. But
Yep.
have we hit the bottom yet? Crystal ball. I
No,
know,
look,
I know.
remember, this one man's opinion. I think the pain is just starting right now. We've seen it coming and we keep thinking it's here, it's here, it's here. I am having more investor conversations now. I had a conversation with a gentleman recently who said that only 25% of his real estate portfolio is performing. That's a low
Yeah,
percent, right?
yeah,
We are not used to losing money in real estate. Interestingly, we are used to losing money in the stock market. We just
yeah.
accept it. But I'm just think about that for a minute. People, who do you know hasn't lost money in the stock market? Everybody has,
No,
but they keep
yeah,
coming back, right? I
yeah.
stopped coming back because I'm tired of losing money. This real estate thing is just different. They don't expect to lose money. And I'm just telling you, now's the time to buy, because people still need a place to live. That's why
Hmm.
multifamily. That's why I don't do office. That's why I don't do medical. That's why I don't do storage. If we don't need a place to live, the investment's probably not what we should be worried about. We got
Yeah,
bigger.
we're seeing some stock market scaries right now because you mentioned Warren Buffett. He has a lot of money sitting on the sidelines waiting for those undervalued opportunities to buy. So the stock market currently is overvalued and people are feeling it. They're aware of it and they're looking to take some money off the table to say, I'm going to buy low, sell high. Right now, it's overvalued. I'm going to sell. And it's very difficult for people to sell when it's doing well. But the people with the stock
Mhm.
market scaries are coming in and saying, I need to diversify a portion of my portfolio into something else because I feel like real estate's currently undervalued. It's going to be becoming more undervalued over the
Yes.
next, say, year.
Yep.
And stock market, they feel is just teetering. Do you feel like that you've seen that before in real estate since 2008? Because we only lose money on real estate like every 10 to 12 years, but we lose money in the stock market more frequently than that.
All the time. Yeah. Yeah. I don't know if I don't track money out of the stock market into real estate. I do think we've got probably 12 to 24 months right now where it's
Mhm.
going to maybe be the bottom, right? But remember, if just like in the stock market, I can't call the bottom. I'm going to miss it. I can't call the top. I'm going to miss it. But what is
Mhm.
important is that I'm making decisions based on fundamentals. Most of the time, these fundamentals will never let you down. That those fundamentals are: don't over leverage, don't kid yourself about rents, where rents are headed. Just make good fundamental decisions and you're going to be okay. And so whether I bought at the top, bought at the bottom, I'm still going to be okay, because in real estate, all you have to do is not lose your deal. Don't lose your deal to the bank. Let the cycle play itself out, because you've still got rental income coming in. And as long as you manage your debt properly, you're going to be fine. And I think your 12 to 24 months is what you're going to have. But here's what's going to happen. People will be scared. People like us will come in and buy as much as we can. And then that will create a positive momentum. And that's when people will really want to come back in.
Yeah.
That's
So
just
do
what's
you
going
think
to happen.
are the people who are still investing, like I'm talking passive investors,
Yeah.
um, especially retail investors who are still investing right now, do you think that they are being brave because we're seeing this capital? I still institutional investors, they're like blathering, right? They're ready because they know what's coming.
Yeah.
But the retail investors I've noticed have just been very hesitant. And the ones who are in it, like I said, they get it. Do you think that they're being brave right now? Or do you think that people are still being taken in by bad deals because they don't know what to look for?
Yeah. I think you're brave if a passive investor is brave, if he or she is not doing the right due diligence on their spouse,
Mhm.
right? I've got 4 rules I want everybody to follow. I'll do them quickly. Number one, you've got to make sure that the person you're investing with has experience for so many different reasons. We didn't know COVID was coming. We didn't know inflation was coming. We didn't know high interest rates were coming. Those experienced management teams get you out of those problems. Number two, they got to have a track record and not just one of buying, of selling. You've got to show that you've done this thing full cycle over and over. They have to be transparent, and that's why we had our entire track record vetted by Verivest. That's a third-party firm. They don't do it anymore, but they did. I paid them a lot of money to come in and vet 25 years of deals. That was horrible. That was a brutal experience. But it was important to me that when you looked at my deals and my track record, I couldn't just make stuff up because somebody vetted.
Mhm.
And then lastly, they've got to put you first, right? If you're seeing 2 and 3 and 4% fees and everything, you're not being put first. Just make sure that you are. So when I see deals go bad, I look at those 4 rules, and most of the time, the passive investor broke 1, if not 2 of those rules. Right now,
Mhm.
mostly experience and
Yeah.
track record. That's what's got them into trouble.
Now, when we first started out, we bought our first multifamily deal. We did not know what we were doing, right? And the investors that came and invested in that deal were very experienced limited partners. We didn't have nervous newbies or any of that. They explained to us what's going
That's
on. Well,
perfect
like,
investor. That is the perfect investor. Yep.
yes. Yes. And somebody on the team better be experienced. And in that first deal that I did, it was our investors were more experienced than we were. And so that was incredibly helpful because I felt like they had faith in our character, not
Yeah,
necessarily in our track record.
that's right.
And they brought just a wealth of knowledge and stories and connections. If we were struggling with anything, they'd be like, let me put you on the phone with so and so. I always tell people if you want to invest in somebody who hasn't been doing this very long, you better have been doing it a really
There
long
you
time
go.
and
I
you
love that.
know
I
how
love
to
that.
do their deal better. So don't be an inexperienced newer investor investing with an inexperienced newer operator. And that's just a recipe for disaster.
Yeah, but you'd be surprised.
Yeah,
That's what's causing the
happens a
problems
lot.
right now. That's what's causing the problems right now.
Yeah. And I think the deal that we invested on where it did not go well because they were about the same amount of experience as we were. So we had some experience, they had some experience, and it was I probably had a little bit more experience than they did, and it was a similar situation. They weren't new, but they were definitely not hadn't been doing it a really long time, but they're young guys, and I was like, "I really wanna see this company build." And it's funny because the other properties they bought at different times and different conditions are still doing well. That's the frustrating thing to watch, is
Yeah.
that they
So you
weren't
know how you solve
completely competent. Yeah,
go buy the experience. Just pay for it.
yeah.
Seriously, think
Well,
about that because that experience will save you. Because
yeah,
the problem is most of the time, what trips people up is things that they didn't even know they didn't know.
yeah,
And it's not that they're trying to mislead people. They're good, solid people. They just, I didn't even know I didn't know this. Oh my gosh. And this is what killed me. This is what took me down. I didn't even know what was out there. You don't know the bear is behind the tree. You don't know. You just don't know. And I think that's what happened. So that's a potential solution. It's go buy, go pay
yeah,
for real honest, somebody who cares. Don't, a lot of people take your money for advice, but get somebody who cares. And now they can give you, and then listen to them
yeah.
because that they're going to give you all the negative downsides that you need to look for and use that advice because it's super valuable. Just trust me. Protect the downside in this business and you'll probably be okay.
I have seen, I don't know if it's a trend, but a lot of people who are guaranteeing the loans, putting their balance sheet up, and they may even have a lot of experience doing this, but they are completely hands off. They give no advice. They never show up to the
Yeah.
meetings. They may have shown a liquidity to the lender. They have no intention of injecting any of that liquidity into the deal. And I'm finding that newer operators tend to be using like this experienced person. They're showing this person off to say, hey, this is an experienced guy on our team, but he's not committed. He's in there. He's getting equity to sign his name. And that's what it is. So
It's called a KP.
like, how do you make sure that experienced person on the team is actually going to lift a finger to help?
Yeah, that's a good question. I sometimes people that sign on to be KPs don't even understand the role of KP. They don't realize
Yeah.
that they're signing on that loan. Those carve outs are there for a reason. And if they wanted to come after you personally, that's what the purpose of those carve outs. So we would never
Mhm.
just sign on those loans because we would want to have the ability to step in and fix things. So I don't even have a good answer for you as to why they would do that because it seems to me they're potentially at risk here because
Yeah,
they're on that
I agree.
loan. So I can't, I don't even have a good answer for you there. I don't know why anybody wouldn't do that. But maybe if you're going to have someone sign on and be part of your team, vet them out to figure out, okay, are they going to give you the time of day? Are they going to help you be successful? And I guess that's vetting like any other vendor that you would have.
You mentioned that you're vertically integrated. And I think that when we were dealing with our first at bat with more institutional capital family offices, that was a deal breaker for a lot of people. We'd get on the phone and they'd say, are you vertically integrated or use third party? And we say, oh, we're using third party. And they'd be like, yep, done. And they're like, I cannot invest with somebody who's not vertically integrated because it's in like the family charter that we cannot invest
Yeah.
unless it's the thing. And they had a few others. I would see them coming up again and again, but that was a big one. That was a big one. And so the people
Mhm.
who sign on your loan, are they usually affiliated with you or how do you structure?
I'm the only one that signs on my loan.
Okay.
I'm the only one that signs on our loan. So if we have a JV partner, they will sign as well.
Hmm.
But yeah, I don't have people. I don't use KPs. I just don't.
Yeah.
Yeah, I
Yeah.
just don't. I don't like the concept. It doesn't mean that you shouldn't use them to help get deals done.
Yeah.
I'm not a fan of the concept. But
I think if they're carrying the entire loan, that bothers me because it's like, what skin does the operator have in the game? That was another question we got our first, like I said, our first at bat with family offices. Like, what percentage of the equity is coming from the general partners? And they want 10, sometimes 20% from the GP itself. Like, they want to invest in a joint venture. They don't want to invest with a couple of new guys who are broke, who got one rich guy to sign on their loan. And it's not going to
oh,
touch it. And then they went and syndicated the rest of the equity or 100% of the equity they needed after the loan down payment.
yeah, no, if you're
Eh,
syndicating your GP interest, that's bad. Then
yeah.
now you're yeah, I'm not saying it's bad. That's not the right word. It's just it is a way to get a deal done,
It's
but you're right. Family LPs, they're not gonna. And if I were
so
them, I wouldn't like it either.
bringing on a partner who's willing to put money into the GP and sign on the loan, they're a little more rare, right? Because they want to spread themselves out signing on loans. And so if they put money 10, 20% in every single deal, that would limit the amount of deals they could do. So I don't like the KPs who are shopping and spreading themselves out like that.
Yeah,
I feel like they should have some skin in as well, some cash in there, and also
should.
show
Yeah,
up to the
but
meeting.
remember, you're going to LP if you're going to big LPs who wanna be all the equity, they're gonna see what's happening is they're imposing their requirements on you.
Mm,
I don't put 20% of the equity in my fund. That would be massive money. We've raised 45 million. That's a lot of
mhm.
money. So that is more unusual than usual. And that's part of the reason why family LPs, they have their deal and they're going to check their boxes. And if
Yep.
you don't hit it, you're not going to work with them. We just have never worked with the family
Yeah.
like that.
So let's go back to the beginning when you were talking about your experience with private equity and you're like, "Hey, we can do private equity through this thing." And it wasn't institutional at that point, so you're probably working with the institutional side on the M&A, right? But then you went to the retail for your own business. Am I understanding that correctly?
Yeah. I didn't raise money for our private equity client. We were a CPA firm. So we did due
Mhm.
diligence, we did transaction structure planning, all that kind of stuff. They raised their own money. They
Oh,
raised billions. These were, you know, big firms.
okay. So that structure there, I'm curious about because it was before. What kind of syndication, what kind of legal structure were you using, and how was the money actually flowing into the deal? Because I think a lot of us forgot that people still used to do these deals before, before 2015,
Yeah.
and we could still structure them that way that we could before. We just have more options now. So tell me a little bit more about that, and then
You
we
mean
can go
early on?
on.
It was like it was people that we just knew. Hey, do you want to put some money in our deal? Do you want to go in this deal with us? And
Mhm.
it was very informal, right? They were
Mhm.
all part of the deal. And it was pre Jobs Act, you could do these deals, but I couldn't go out of the internet. I couldn't have this conversation about our fund four. I wasn't allowed to do that,
Yes.
right? You just weren't. But if you and I knew each other for a long time, there was nothing wrong with, hey, you want to go, you want to be in my deal? Yeah, cool. Yeah, that was legal, and you're in the deal, right? You're not, hey, I'm hands off. You just tell me. It was very different back then. So the circle of influence is very small. I didn't grow up with a big Rolodex. My first deal I raised was 1.2 million between me and my buddy. We worked
Yeah.
very hard to raise that money. Trust me. You have no idea, right? We were just working on every one of our friends, and we got a few to trust us, and that's how it happened.
Yeah. How are you structuring things now? Like you said, now you can go on podcasts and talk about it. So
Yeah.
what do you look like at this point?
We're 506c. We're accredited only. 506c means we're only allowed to accept accredited investors, and we run the whole gamut. We verify. We do everything you're supposed to do because
Hmm.
you don't want to get in trouble with the SEC. Bad idea.
Yeah. Yeah. I've had a few friends who were exonerated from an SEC investigation. They said I wasn't even allowed to represent myself. I was required to hire a securities
Yeah, I don't
attorney. And
want.
they're like,
Let's not go down that road. I don't even
yeah,
want to think about that.
they're like, it's just put me at their mercy. So keep your nose
Yeah,
clean, keep it straight, do it right.
yeah.
It's
It
not
is
worth
not worth it. It is
question.
not worth it.
Yeah, definitely.
The rules are
Um,
not that complicated.
Yeah, and I find that they're not as I felt like they were really complicated when I first started, but as I started
Work.
diving deeper into it, it was like some of them disagree with each other, some vagueness and at the beginning I was like, "Well, how am I even supposed to make a decision?" But like you said, just stick to the fundamentals. Like just stick to the basics and stay way on this side.
Don't stretch. Don't
Yeah.
stretch.
Yeah,
Yeah.
don't get creative. And the reason people are getting creative is because they feel like they can't raise money unless they expand their ability to talk to people. Oh, you came to my meetup, so I'm going to mention my 506B deal afterwards. Or they're getting very creative because they don't feel like their network is big enough. So if you feel like you have to get creative to raise enough money, then maybe you should do a smaller deal.
Yeah. There you go.
Yeah.
There you go.
Um, Oh, so Ken, thank you so much. I always ask everybody at the end
Yeah.
of the show, and maybe the reason I ask this, people say it's their favorite part, and so it
Okay.
keeps them listening till the end. So it's not just like the boring part, and then they click off next to the next podcast. But first, tell us how people can get a hold of you, and then finish up with why people should get a hold of you.
Yeah. So KRIpartners.com. That's our website. That's the easiest way to get to us. And when you get to our site, our entire company is based on helping you figure out there is a better way to create wealth. I believe that. I've known that for a long time. Now you just have to figure out how it's going to fit into your life. And if you want to learn to do your own deals, we've got an entire education program that can get you there. We're going to teach you every single thing that we do and that we have done. We're not going to hide anything. We're going to show you what it is we do, even down to our underwriting spreadsheet. And then, hey, that's the do with you kind of thing. If you want us to do it for you, then turn right instead of left and invest with us in our funds. But more importantly, reach out to us, have a conversation with us because we need to understand what you're really trying to do. Because I need this. I need a good match. Even with our passive investors, we need to know that our goals match your goals so that it makes sense. So KRIpartners.com, that is the best way to get in touch with us and figure out how you're going to put this real estate thing in your life.
Yeah. Perfect answer. You can't do any of this until you have a conversation and we get to know what you're looking for and what you're needing, individual phone call. And I find people are just afraid to make that first phone call because they're afraid they're going to get into an email drip that they can't get themselves out of.
Yeah.
But I don't know. Like you said, you vet a couple of operators. You're not going to endorse any one sponsor, but it's invest some with Ken, invest some with us, invest some with this
Team.
other guy. Vet it out. Like
Yeah.
you need 5, 6, maybe up to 12 operators, depending on how much cash you
Yeah.
have to invest. And then you don't have to keep vetting them out, and if one of them retires, then you're not left,
You're good. Yeah.
with nothing. So, just that encouragement, if this is something that you're interested in doing, whether we have options for active investors and passive investors, both of us at both of our sites, just reach out, figure out where you're best suited, where you're gonna be happy, try some things out, and see if this is a good path for you, because you wanna be one of those super experienced limited partners, someday who has had a more reliable path to building wealth. Isn't get
That's right.
rich quick, but it's guaranteed to get rich eventually if you don't quit. It's like, thank you so much, Ken. I appreciate you coming on the show and sharing your wisdom.
Thank
Like,
you.
I really loved the nitty gritty deep dive of what you're doing and what you're helping your investors accomplish. So thank you so much.
Thanks for having me.
All right. And until next time, reach out. Tell me about your next passive income adventure because I really am looking. That's part of my favorite part of what I do is listening to you tell me your individual stories. That's why we do this podcast in more of a storytelling format. Is because I just find that those are so interesting. So reach out and tell me about your passive income adventure that you want and let us help you figure out how to get there. Thanks, everyone.